Hello there, this is Manuel Vargas with Keller Williams Realty Landmark. And before I start my fourth quarter Queens real estate market update and our real estate forecast for 2021, I would like to wish you a very happy new year 2021. And I also would like to say that uh, I know that a lot of people are talking about 2020 being very challenging, and people are reflecting on all our challenges, which we, by the way, which we already have those challenges. I would like to make an emphasis on the opportunities and on how this crisis it can be also a portal, can be also an opportunity for renewal. I think that I do have a sense of gratitude because we all became more aware of what is important in life, what is essential. Um, we became more aware of about quality of life, not just about productivity, right? About what is important for our happiness, and we became more aware about efficiency and sustainability. So I have a sense of gratitude for what happened in 2020, in spite of all our suffering and our challenges. And I do think that we're gonna uh, get back, come back stronger. So without further ado, let me talk about the fourth quarter of 2020 in real estate in Queens. So here we have a summary of 2020 done by our multiple listing, the One Key MLS. What is important to note about the One Key MLS is that they put together these numbers taking into account all residential real estate properties, meaning one families, two families, small multifamily, three and four families, and apartments, condos, and co-ops. And so these numbers are which what every other real estate agent are looking at. But because we have a little bit more experience, we are 26 years in the market, we realize that there are submarkets, not just by different areas, but by different property type. So I'm going to give you this summary that our multiple listing gave us, but I'm going to do a separate analysis, property class by property class, and that's going to be very enlightening. It's going to be revealing. So in 2020, the closed transactions were 6,446, which were 21% lower than in 2019. In 2019, we had 8,178, obviously because of the pandemic. As far as negotiability, difference in prices from original listing price to the final closing price. This negotiability came down. It was 5.6%, that difference in 2019, and in 2020 it was 5.3%. This signifies an increase in demand and less inventory year over year, right? For all residential property types. The median price in 2020 for all these properties were 640,000, and opposed to the median price in 2019, which was 625,000. This is a yearly increase year over year of 2.4% in median price for all residential property types, which signifies a pretty healthy market in spite of the pandemic. Now, as far as inventory, the year ended with 6,744 units, which at the current pace of sales equals 7.4 months of inventory, which is a buyer's market, as opposed to 4,754 units in 2019, which at the sales pace of 2019 was 7 months, which was a slight buyer's market. So the market is skewing towards more of a buyer market, but this is for all property types put together. we're going to see that if we take every property type individually, this is a little bit different. And I will do that in a little while. Um, the, the year ended with a record in existing home sales at the national level of 600.76 million of sales for existing homes. This is a 14-year record, quite remarkable, and signifies the strength of the real estate market at a national level. We're going to see that Queens also has bright spots in just a minute when we get into our analysis. But this was quite a year nationally. I want to recap how the third quarter ended and how the fourth quarter started. The story was in the third quarter, the exodus of buyers from the New York City to the suburbs. In Queens, this resulted in an increase of the median price for one family houses to 680,000, and a slight increase of two family median prices to 180,000, and a stabilization in prices for 3 and 4 families, small multifamilies. Condo median prices at the end of the third quarter, were 4% lower at 530,000, and co-op median prices went up about 1% to 300,000. So transaction counts for all property types were down, and the story was that one family prices were higher because people were looking for more space. People were looking not to live together with a lot of other people, and they wanted space to work from home. They wanted space to work out, space for entertaining their own family, cooking, and backyard space. So one family prices were the brightest spot increase in the third quarter of 2020. As far as how the fourth quarter started, I wanted to say that we were working in a fundraiser to raise money for the food pantry of the First Presbyterian Church in East Elmhurst, and we raised enough money to feed 500 families. And I wanted to say thank you to many of you who were very generous and donated to this campaign. That's the way we started the fourth quarter, and it was a very positive sign, seeing how our clients, in spite of all challenges, were generous enough to make this campaign a success. In general, the fourth quarter started with the uncertainty about the general election, and we did see buyers and sellers hesitating a little bit to pull the trigger whether to buy a new property or put the properties on the market. But the interest rates continued being at record lows, ended up the year at record lows at about 2.7 for 30-year mortgages. And that was what sustained the market. We believe this is what prevented the market from coming down and reinforced prices and created an increase in demand. The decrease in mortgage interest rates all along the year and also in the fourth quarter of 2020. At the beginning of the new year 2021, we did see an increase in rates because rates tend to do better when there is an optimism about the economy, and also when 10-year treasury bonds, the yields go up, and this happened at the beginning of the year. So we do have to start paying attention to the rates because the rates provoked an increase in demand and reinforced median home prices all around the nation. And if the rates go up, the story may change. We'll see what happened in 2021. Another important factor in Queens in 2020 is that the unemployment spiked very highly to almost 20% because of the pandemic, but it did come down in the last quarter to 11%, which is still pretty high, but it showed positive signs for the employment. It's still high at 11%, but it came down from 20% levels in Queens in the last quarter of the year. Another important aspect of the Queens market is the rental market. Queens has a lot of rental properties, a lot of multifamilies, and it's hard to come by the data. We look at Miller Samuel, the appraisal firm data for Northwest Queens, which is a very strong rental market usually. And in Northwest Queens, year over year, the rental prices were down by 40% and the inventory was up by 45%. So what we are seeing by talking to our clients and by looking at the rental market is that there is a lot of availability, a lot of vacancies, and landlords are offering a lot of incentives to tenants to get these apartments rented. So this is important in Queens. And here we are with the data that I promised you by property class by property class. If we look in the last quarter, how it ended for one family houses, this is quite a bright spot because even though the number of sales came down year over year from 3,261 to 2,726, a decrease in sales numbers of 17%. The median price went up for one family houses by 3.8%, from 665,000 median price in Queens to 690,000. So quite a very bright spot in the market for one family houses. For two family houses, the story is positive, but not by as much. Transactions numbers went down from 1,597 in 2019 to 1,249 in 2020, down by 21%. The median prices went up just by 0.8%, less than 1%, from 870 in 2019 to 875 in 2020. So the median prices went up, but not by as much as one family houses. Now let's look at 3 and 4 family houses. Transaction count came down by 32% year over year, and prices came down by 6% year over year, median prices. And what is happening with multifamilies, small multifamilies in Queens, is that because there is a lot of restrictions, we have a strict protocol to show properties. These tenanted properties are more difficult to show and to market. We can still sell them, but we have to follow a certain protocol. So they sell more slowly. Also because of the rental market situation that we just saw in the previous slide, these properties are more affected by the pandemic. And so the transaction count came down and the median price came down by 6%. The good news, I would say, is that the median price came down not by a lot, taking into account the crisis we are going through. They came down because rentals are at a standstill and because the marketing of these properties is more challenging right now, and you need a lot of cooperation from your tenants. And that is a different story to what happened to one families and two families. So here you have what's happening property class by property class. And I'm going to tell you in the next slide what's happening to inventory levels, which is different for all these classes. Here we are. For one family properties, there is an inventory, a current inventory right now of 1,504 homes, one family homes available at the end of the fourth quarter of 2020. And this means at the current pace of inventory, which is 501 homes sold per month in 2020, this means 3 months of inventory, which is good news for the sellers. This is a clear seller's market. Now, with two family houses, there is right now, or there was right at the end of the fourth quarter of 2020, 975 homes. And at the sales pace of 2020 per month, which was 230 units sold per month in 2020, this means an inventory of 4.2 months. Anything below 6 months is traditionally a seller's market. So two families are also, the market for two families is also a seller's market, not as pronounced as the one family market, but it's still a seller's market. But when we look at the market for 3 and 4 family homes, small multifamily homes, the current inventory is just 213 homes, less homes available than two families and one families. However, at the pace of sales of 2020 per month, which is 23 units per month, we have a 9 months of inventory for small multifamilies coming into the new year. 9 months of inventory being above 6 months of inventory is a buyer's market. So these small multifamilies are in a clear buyer's market coming into the new year. We're going to take a look at co-ops and condos, separately in the next slide, and you're going to see some surprising information. Let me go back to that. So for co-ops and condos, for condos first, in 2020 there were 523 condos sold, which is 28% below the sales of 2019, obviously because of the pandemic, and the median prices were 2% lower in at the end of 2020 than at the end of 2019. They were at 532,000 median price for condos. There are currently 885 units, 885 condos available, which at the sales pace of 2020, the average sales pace signifies a 19 months of inventory for condos. This is a very marked buyer's market for condominiums. Okay. Now for the market for co-ops, the transactions, the transaction counts for sold co-op apartments was 1,878 units, which is 26 units below the 2019 level, obviously due to the pandemic. And now what happened to the median prices of co-ops? At the end of Q4, the fourth quarter of 2020, the prices for co-ops were surprisingly higher, 2.3% higher than 1 year ago. However, the inventory for co-ops was at the end of the year 2,112 available units, which at the current sales pace of sales, for co-ops, is 13 months of inventory. Not quite as high as the condos, which were 19 months of inventory, but still over a year of inventory in co-ops. So we can expect the median price of condos and co-ops to adjust down this year, at least in the first half of the year, because there is a glut of inventory for apartments, quite different to one families, two families, and also small multifamilies. Um, another for you guys that are into numbers and statistics, this may be a little too advanced for some of you guys, but I'll try to explain it in plain English. At the end of the quarter, and this is data from Miller Samuel, the appraisal firm that does research and statistics for real estate in Queens, the median price and the average price, this is average price and median price, both went up but got very close together. They were almost the same. So we all know what average price means, but the median price being the price in the middle of all sales, right, was very close to the price, to the average price. This means that bunch of sales were bunch or were accumulated close to the median and average price. Most of the sales happen around there. This is called in statistics asymmetric distribution. But what that means is also is that sales at the lower end, below the median price, were very few, and these are cheaper units, which could be co-ops, and it could be distress sales, foreclosure sales, short sales. Why? Because the government has a moratorium in foreclosures and motivated the lenders to offer forbearance to many sellers, so there is not a lot of distressed sales, and there is not a lot of cheaper value sales, because we saw that the apartment market is slowing down a lot. This also means that in Queens, not in other boroughs or in other counties, in Queens, higher end sales are also fewer, because what happens is that for luxury home sales in Queens, we are competing with Nassau County, Suffolk County, the Hamptons, Connecticut, upstate New York, where higher or luxury buyers are going, because they have more space, they have more of a choice, more property, and a space to work from home, to work out from home, for homeschooling, and for entertaining in the house. So both sales at the lower end of the spectrum, at the cheaper price end, and at the higher end are less, and that's what makes the average price closer to the median price. I found that quite interesting. That means that if properties are priced somewhere around that, closer to that average price for your property class, you are in a very active market. A couple of other pieces of information that I want to talk about is what happened in New York City during the last, New York City administration. There was a big push towards affordable rentals, to support affordable rentals to benefit tenants. And also there was a change in the rent stabilization laws, also benefiting tenants. This was, I think, an incomplete approach, because it took into account mostly the needs of tenants, and it didn't take into account the motivations and goals of landlords, that are the ones who build affordable property, and that are the ones who renovate property. So I think it was positive, but it was incomplete. We do have a new administration coming in, and I think that the landlords part of the puzzle has to be included to have a complete picture. So this sums up my analysis for the fourth quarter of 2020. I hope I have been informative to you. If you have any questions, you feel free to contact me through social media, through my cell phone, 917 559-2002 or by any other means. But I wanted to venture my very bold predictions for 2021 because a lot of people are just talking about what happened, and it's relatively easy to interpret the data. But we also have an idea of what's going to happen in 2021. For example, the effect of interest rates. It is obvious that interest rates affect the real estate market. But when you are at record levels of median home prices in Queens, motivated mostly by decrease in interest rates, if interest rates stop decreasing and start to increase, this may affect prices in a very marked way. So we need to stay tuned to what happens to interest rates because the Feds, they don't have a lot of room to lower rates anymore. And if the economy improves, we may see a change in rates. And the effect on prices may be very marked because the effect going up was very marked as well. Another forecast that we are proposing for 2021 is that there will be an absolute seller's market for one-family homes because people will continue to look for more space, for not living in close quarters with everybody, with more people, I mean, and for space to work from home, for space to work out from home, to do homeschooling, entertaining, cooking, etc. So one-family houses will be in a seller's market, and to a lesser degree, two-family houses because they don't depend as much in rental income. There will be an absolute buyer's market for small multifamilies, 3 and 4 family homes, for these very reasons, especially at the beginning of 2021 and in the first half of 2021, because a lot of people do not want to live close to other people and share facilities, hallways, and common areas with other people. And because investors are looking at 3 and 4 family houses are a little bit careful right now because of the status of the rental market. And because also the inventory for 3 and 4 families is higher. So a buyer's market at the beginning of 2021 is what we forecast for small multifamilies, 3 and 4 families. Residential rents are lower and will continue being lower, and landlords will continue to offer concessions at the beginning of the year, and this trend will start stabilizing towards spring and at the end of the year. We already started to see that the market with all this, the rental market with all these incentives is starting to become a little bit more active, and people are starting to trade their units for better units. And so these deals will dry up, and at the beginning of the spring, if these vaccines that we have proposed start making a dent on the pandemic, then the economy will pick up and people will start coming back to the city, right? So at the beginning of the year, there will be a continuation of these concessions and these lower rents, but then towards the middle of the year, this will stabilize. And at the end of the year, we won't have as many of these deals for tenants as we have right now. The trend to work from home, from home, will continue beyond the pandemic because people are starting to realize that a lot of the work that they do can be done remotely, not all, but a lot. And working out from home is more convenient, it's cheaper. But we believe that at the end of the year, as the economy improves and companies start calling their workers back to be present at the office because there is still some value to do certain things in person, towards the end of the year, this trend is gonna slow down a little. But beyond the pandemic, there will be a, a lot of working from home and working out from home also, beyond the pandemic. Not so much for homeschooling because a lot of parents are tired of homeschooling, and because it has been proven that homeschooling is not quite the same that in-person learning, right? So this is one of our forecasts. Um, the Another one of our forecast for 2021 is that the vaccine success will spur employment in New York City, right? And with this improvement of employment in New York City, a lot of people that left the city are going to realize that New York City is more affordable in certain ways. For example, you don't have to commute, right? So when people are being called back to their offices and they have to start commuting again and lose 2 or 3 hours of their day, 2 or 3 hours of their sleep, or 2 or 3 hours of their family time, they're going to realize the value of living in your city. This is a forecast that we propose towards the middle and the end of 2021. And also, this affordability of New York City is signified by real estate taxes. A lot of these suburbs, a lot of these people that run or run to the suburbs are paying quite a lot more in real estate taxes. The typical one family house in Queens, for example, pays 6,000, 7,000, sometimes less, 5,000 in real estate taxes. In the suburbs, it is not unheard that you pay 16, 17, 18, 20,000 in real estate taxes. So the affordability will be discovered in New York, and this is a forecast that we propose for 2021, along with the realization of people that um, commuting times matter and make a dent in your quality of life. So our eighth forecast for 2021 is that the urban to suburban exodus will subside and New York City comes back with a roar sooner and stronger, um, you know, than most of the other properties, and much stronger than what we saw in Q3 of 2020. This comeback of New York City is going to be strong because people are going to see the value of living uh, in New York City. Uh, Commercial real estate. Commercial real estate, meaning retail, um, office, and mall space, will need to be reinvented because even though New York City will come back with a roar, there will be a surplus of office space, even though uh, the commercial market will see a recovery towards the end of the year. There will be a surplus of space. So a lot of this retail space, because we have this online commerce and online activities that we're getting used to, like ordering food online, ordering your groceries online. A lot of that will continue after the pandemic. So retail, office, and a mall space will need to be reinvented. The one bright spot that we see is warehouse space in suburban areas for the same reasons, because a lot of these online companies that do e-commerce need warehouse space, be it for storing the items closer to the urban centers, or maybe for cooking. There's a lot of industrial cooking going on right now. We don't see that because we see who we order from, but there is a lot of industrial kitchens that are being set up in warehousing spaces. Um, Also, another one of our forecasts is that distressed homeowners will receive support from the government. So we are not going to see, um, you know, a lot of foreclosures and an increase in distressed sales, because there will be an effort by government, like we saw in the year of 2009 and 2010, to facilitate the banks to modify mortgages and to avoid short sales and foreclosures. And I think this is positive for the general market, because foreclosures, destroy communities. But it is also very positive news for banks, because if banks have to foreclose, they may lose more than 20% of the value of the asset. So this effort by the government that I am forecasting to avoid foreclosures will benefit both communities and lenders, because they will not have to foreclose, like when the foreclosure crisis of the credit and loan associations, at the end, at the beginning of the 90s. So there will be an effort by the government to support struggling homeowners, and lenders will benefit from that. Now, this will come hand in hand with the tightening of the lending standards, and we're already seeing that in our own practice, because lenders are starting to be a little bit more demanding with their standards, and especially with their appraisers. That means that when you put your property for sale, you want to sell your property, you want to position it correctly on the market, because banks are going to become a little bit more conservative with valuations and with their lending standards. That also means that we as your brokers, if your broker has experience, they will vet your buyers more carefully, and that if you are a buyer, you want to get pre-approved the correct way. You want to do your homework before you start looking for a home, because lenders are going to become a little bit more demanding. Finally, in New York City, like I was saying before, with a new administration, there will be a big push to understand affordability, to understand the big picture of affordability. It's important to support tenants. It's important to have affordable rental units for tenants, but landlords need to be included in this affordability drive, because landlords are the one who invest the money, and landlords are the one who renovate apartments. So I do believe that affordable housing is important, but what I mean is that landlords will be included with the new administration in this new initiative of affordable housing. Also, I would like, as a broker, I would like to see the new New York City administration put forward a plan for affordable home ownership in New York City, not just affordable, rentals. I want to see also affordable home ownership in New York City, because this, we all know that home ownership is a creator of wealth in general for homeowners and for the economy in general. So I think the new New York City administration should look not only at affordable housing from the perspective of rentals, but also from the perspective of home ownership. And having said that, I know that a lot of you are thinking of whether this is a good time to sell or not. And I would tell you that yes, this is a good time, because for a lot of properties, there is not a lot of properties on the market yet, before the spring comes. And if you are wondering about your property value, we can offer you a free market analysis, accurate. We have 26 years of experience in Queens. You can call us at 917-559-2002. And we want to make an emphasis that we we have your safety in mind, and we do follow all CDC and NYSAR, New York State Brokers Association guidelines for the COVID protocols. So yes, your property can be sold safely, and it's a good market for many of the properties in Queens because there is not a lot of properties available yet. We do expect more properties coming in the spring, but right now we don't have a lot of inventory, especially for 1 and 2 family properties. I hope this has been informative. If you have any questions, please feel free to contact me through social media or to call me at 917-559-2002. And thank you for listening to us. Thank you.